Disclaimer: this session is strictly for educational purposes and should not be considered as a legal, accounting, or investment advice. This session does not represent an offer to sell or a solicitation of an offer to purchase an investment or security. The strategies mentioned in this presentation may not be applicable for everyone. The information presented is believed to be accurate and reliable. We make no representations or warranties, expressed or implied, as to the accuracy of such information, and we explicitly disclaim any and all liability that may be based on such information and/or errors or omissions thereof. Please consult with your own attorneys, financial advisor, and CPA for legal matters, investments, and any specific tax situations. This session is strictly a knowledge sharing session and for educational purposes only. Welcome to another Learn and Grow series. I'm your host, Loomba, a real estate investor. Today, I have my very good friend, Andy McMillan, as our guest. A little bit about Andy. Andy is a fund manager at Legacy Acquisitions, which is focused on partnering with world-class operators while delivering white-glove service to his investors. Andy values his long-standing personal relationships with brokers, operators, institutional lenders, and private equity firms, and has scored over $750 million in commercial real estate transactions over a period of 20 years. Andy graduated from UCLA with a degree in economics, and he's on the board of advisors of a number of top flight companies across the US. And he's active in many communities and national organizations. So today our topic is, what do you need to know about the horizontal multifamily? And horizontal multifamily is one of Andy's expertise, and we're going to learn from him. So Andy, stage is all yours.
Yeah, thank you, Vinky. So I've been in this game, as Vinky mentioned, for quite a while. Started off in the brokerage business and then kind of evolved into doing development deals, mostly in California. I see, I think there's a couple of California, maybe Riverside, I think I saw. So we were doing stuff at Venice Beach, probably one of the most difficult places to get deals done. So I think I learned a lot about that, the development process. And then we started partnering up with other operators, buying mostly multifamily, Central California, Southern California, and then kind of moved southeast, where we feel like that's the area where we can kind of create the most value. And so about 3-4 years ago, we really started honing in on this built to rent trend. And we call it a trend, but it's really not, right? It's been going on for many years, as you all know. It kind of in 2008, when Wall Street kind of bought a bunch of single family homes, they started managing them in what they called these kind of scattered sites. And so they would have multiple units in multiple counties, and then they'd be trying to figure out how to manage them. And then it became much more favorable at some point, and a genius said, hey, let's build a bunch of units next to each other and manage them just like multifamily projects. And that makes a lot of sense for a number of reasons, which I can get into. But just to kind of put a bow on it, Vinky, and then I'll let you let it breathe a little bit. When we met our partner in Lafayette, Louisiana, probably a few years ago now, he had been doing this for many years, really on a smaller scale, 10, 20, 30 at a time, would build them, stabilize them, sell them off. And then at some point he said, hey, look, you guys help me scale this thing. And so now we've got a few projects underway. I think we've got about 600 units right now underway, either in the entitlement phase or finishing entitlement or in the development stage. So we can talk a little bit about that. Vinky, was there anything specific you wanted me to hit on?
Yeah, I would like to understand from you exactly what is this horizontal multifamily is, first of all, because it's a very fancy name, right? So
Yeah.
it's like a lot of curiosity to understand what exactly is it and what is your target markets, if we can
Yeah,
talk.
yeah. So if you think about, just a multifamily project pulled apart with a backyard, horizontal multifamily, they all mean the same thing, built for rent, built to rent. Basically, what we're building is single family houses right next to each other with big backyards and a doggy door. It's really as simple as that. Now, some communities, for instance, in Lafayette, Louisiana, will build a dog park and walking trails, etc. But we'll keep them really simple, like 3 2 bedrooms, maybe 15 to 1600 feet with the larger backyards. And then we'll, it depending on that market rents for about 1700 a month. That's great rent for a market where we can get land relatively inexpensively. So, low impact fees, favorable municipalities, guys that really want to help that community grow. So that's a little bit about what what built to rent is. I think it's starting to evolve a little bit where maybe built to rent was kind of competing a little bit more with people that were just used to being in houses and wanted to rent houses more scattered. Now, I think as we're building more projects, we're figuring out that a lot of people really want to have the amenities, the clubhouses, the pools. You're kind of pulling a lot of people from the multifamily and from homes. I mean, there's never been a larger spread in the amount people are paying for their mortgage and the rent. Right now, it's about 850 a month. So you can kind of imagine, the reason a lot of people are interested in built to rent is think about, really it's three things, I think. It's what's the affordability, and what I mean by that is guys that could buy a house and a mortgage maybe a year ago or 2 years ago at 3%, 3.5%. Now they're paying 6 or 6.5%, right? I think that's what I saw today. They can still rent for maybe 30 to 33% of their income. So I think that's one kind of factor why a lot of people like built to rent. The other is the rising rents. And I think I was at a conference this last week. Some would even kind of argue that the higher interest rates favor built to rent because of that very reason, where you would have more and more people that would need to rent, right, as opposed to being able to buy. And then I think the third is just obvious. There's very little supply. There's very little supply in most markets. I think we tended to think after 2008 and much more of a kind of like a national view, like the music stopped for everybody, right? There was no rates. You couldn't get a loan if you wanted to. You couldn't get a mortgage. Now I think we have to think of it as a much more localized market. Like I can't remember who was in Riverside, but Riverside is one of the top markets in the country. It sits in one of the worst states in the country, and I can say that only I can say that because I'm in California. But there's a lot of favorable, kind of smaller governments that really want to help built to rent grow. So that's I'll let it breathe a little bit, but that's kind of why we like it so much.
So what markets are you in?
So we like the Southeast. So this year we've done on the because I know there's a lot of multifamily folks here too, and we still like multifamily, right? We did a North Carolina portfolio deal in Winston-Salem with a partner. We did a Houston deal with Emma's group. We invested in Austin. But as far as the built to rent, where we feel like we can really buy inexpensive land, and just to give an example, in Lafayette, Louisiana, we can buy all in. So that includes the land, all of the infrastructure. So that means streets, roads, utilities, and then all of what we call the vertical, which is the unit builds itself. We can build that right about a 140,000 a door, which is really inexpensive, right? When you consider some of the other markets, like the larger markets in Texas and Arizona. And part of the reason is because you've got much more favorable local government there. And if you can get rents in that, we started, I think, our underwriting at 15, and it's kind of climbed to 17. So there's some luck involved, obviously, for everybody on the rent side. So that we like that market. And then what we started to figure out, Minky, is why don't we consider following some of the other larger, not necessarily REITs, but let's just say Wall Street money, guys like D.R. Horton, who were doing built to sell that decided to do built to rent. They're going to other secondary and tertiary markets like Foley, Alabama, for instance, and there were 2 or 3 transactions there. So we just started to really kind of, with our acquisition team, they've been doing development deals for many years with a lot of the larger Wall Street guys. We could go into those areas where there's good schools, there's population growth, there's, we also look like many do at kind of crime reduction. We always taken that into account, but we really want to make sure that that mayor is on board, that community is on board. And as a result, that deal in Foley, Alabama, so we'll build 155 units there. We can build that, and then behind us, there's really no more multifamily building. They just want to have these, the communities that they've already approved, moratorium on any new build, because they basically, they're insulated, they look nice, they've got all the amenities. So that's kind of where we look, is the areas where it's still relatively inexpensive. Obviously, the topography has to be right. You can't go in areas where there's just tons and tons of trees, etc. And the people that we're working with is really the key, right?
So let me ask you this question. How does the DFW market look compared to the rest of the country? Because people are like really bullish about the multifamily.
In Dallas?
Yeah.
Yeah, I mean, so that's kind of so there's 2 ways to look at this, I think, right? And I was at this built to rent conference, this last week, where you had guys that are in primary markets and then guys that are in secondary and tertiary. In Dallas, there's so much, there's population growth, right? Everybody from California is going there. There's the argument to be made that, hey, look, I can build something that's going to last and rents will continue to increase. But on the flip side, land is so expensive there, right? And so where we feel like the delta in between, can we get land inexpensive enough and the rents high enough, right, that it makes sense in the long term? And I think we're starting to see a change now where land costs are starting to come back down a little bit. People are maybe a little bit more reasonable about their land costs. But I worry about those larger markets where you're paying maybe $200,000-$300,000, whatever that number is for land on a unit, and then you're trying to build something where the spread might be a little bit thin, and then you've got to basically bank on the fact that cap rates are going to have to kind of stay low, right? So I still like those markets. I don't think we could build there. I don't think we would have the with our lender, we've kind of looked at some of those other major markets. Arbor's our lender. They really like, some of these secondary, tertiary markets. Not all, that's not all they like, but I think it's just kind of like, as people know, cap rates, they only tell part of the story, right? So if you go and you're building something, even if it's like a heavy value add, right? So let's say that your deal is $5 million and your renovation cost is $1 million. Like that $1 million renovation cost absolutely doesn't tell any of the story if you're using a cap rate as your number, right? As your whatever that KPI is. So if you're looking at the yield on cost like we do in development, that tells much more of the story. So if I just can break that down, because I think it will help some people maybe that are newer to the business in the way that you think about it, especially now where kind of cap rates come in, is if that $5 million is your purchase price, plus that $1 million is the amount of your renovation cost, add those together and divide that by your net income. So let's just say, maybe this is helpful. Let's just say that's $6 million total for your deal and your renovation costs. And let's just say that you've got $400,000 as your NOI. So that's about a 7% what we call yield on costs. Okay. So the reason that's important is have certain cap rates in these areas, in these various areas, right? So if a cap rate is at 4.5 or 5, you want to basically have enough spread above that cap rate so that the deal makes sense. So if, let's say, a cap rate is, 5%, so that's a 200 basis point development spread. Now, the way we can kind of look at what the actual value creation is, which is much more than just, hey, how much is it going to cost us to sell a property at, $6 million at a 4 cap? That doesn't tell us much of the story. But if I said, hey, look, take the development spread of 200 basis points, divide that by what we just considered the yield on cost. So 2% divided by 7.
And you can use the whiteboard too. I made you co-host.
Oh, you did?
Yeah, so people can see what you're doing.
Okay.
I'm more visual, so I won't understand unless you put it on the board.
Open and collaborate. I'll go to load.
If you click on the whiteboards down there, you should be able to.
Yeah, it's giving me a code 7. Have you seen that code 7? Let's see. Let's try this.
I shared with you. It should work. Oh, there you go.
Okay. Open and collaborate. How about this? Can I tell you, because it's showing, look, so when I put on whiteboards,
That's
says,
okay.
look,
That's okay. Keep on, continue. That's okay. I was just trying to make it easy. There you go.
oh, wait, is that working now?
Yeah, it's working.
That was me, Vinky. I was able to get it open.
Oh, you did? Okay.
Douglas Dow, always coming through in the clutch. All right, so, oh, you're gonna
Thanks,
make me
Doug.
write like a little child on this thing, Vinky?
Yeah, I just get the pen thing, just a draw thing, and then you can
This
write.
thing?
Yeah.
Like, you're gonna try and make me write like that?
Yeah.
Oh,
wanna
this
do
is
that?
so embarrassing, humiliating. How do you do like a?
Again, that's okay. You don't have to do that. We can.
No, I'm kidding. I'm kidding. Okay, so let's just say that we've got 5 million. Can I do that? That's the purchase price. Okay, 1 million in renovations, right? And how do you quickly erase?
Eraser. You want me to erase it?
Yeah. How do you quickly do the eraser though?
Everything?
Yeah, everything.
All right, there you
Yeah,
go.
there you go. Okay, so I'm gonna have you
Use
help
a
me out
text
there.
message, use a text to type it so that we can see it. There you go.
Okay. So, oh yeah, okay. This is so cool. I'm like learning how to do this all on the spot. It's also pretty embarrassing.
Yeah, it's a crash
right.
course.
Yeah, crash course. So you can't even see that.
There you go.
How about this? Okay. So 5 million plus 1 million in renovation costs, right? And we're gonna divide that by this by our NOI, which we said was about 400,000. Okay. So what's 400? That should be the other way around. 400,000 is the NOI. Divide that by our total cost, right? What we bought it for and all of the renovations. So that's $6 million. Okay. So that is a 0.7% is what we're calling yield on cost. You can call it, there's a couple of other names for it, yield on cost. And I've seen it written a lot of other ways. But now, so our cap rate, we know in this particular market is now at 5%. Okay. So if our cap rate.
So we can still see what you're doing. It's okay. You can just keep on telling us what you're doing.
You can't see
it. No, I can see it. I'm not sure about the rest of the team.
Oh,
Doug or anybody else?
Nobody else can see it? All right,
No,
good.
we can't see.
Yeah, we can see it. So it's okay. You can just continue.
Oh, okay. All right. Well, maybe you can do it while I'm talking, but
Yeah, actually,
okay,
I can. Andy, I can type it.
Oh, could you? All right, cool.
Yeah.
That's awesome. Thank you, Douglas. Because I think this is helpful for people. I know it's taking a little while to get there, but I think it is helpful for people. Okay, so $5 million plus our $1 million in renovation is $6 million bucks. Now we want to divide our NOI by that $6 million bucks. In this case, let's just say our NOI, our net on income is 400,000. So 400,000 divided by our yeah, thank you. Can you guys see what Douglas is doing?
I can see it, 5 million, yeah.
Okay, so 5 million plus 1 million in renovation costs, Douglas. It's just showing the little bit, yeah. So that's basically 6 million bucks. And then we've got $400,000 is our net income. We would divide that $400,000 by the total of 6 million. Go 400,000 divided by 6 million, and we should get 7%. Now this is what we would call our yield on cost. You could call it development yield, you can call it net yield, but basically it's just the yield on the cost of us building this property out. Now cap rates are rising a little bit, right? So at some point, let's say they've come up from 4.25, now they're at 5. We're going to basically now calculate the development, what we call development spread. Now this is all applicable to if you're doing a heavy value add deal, the same thing. And I think this is even more important when people are considering cash on cash or you know, what's the cap rate going in and what's going out. So if we, here we go. So now we know that the cap rate is 5%, and so we're basically going to do 7% minus 5, and that basically gives us the development spread. So the development spread now at 2% divided by our original yield on cost, it should be what, about 24, about 29. So basically the development lift on this property is 29%. Is that right? 2 divided by 7. Yeah. So what that means is basically by us deciding to do this deal and putting in $1 million in renovation costs plus the purchase price. So if this is a development deal, you could say, you know, my land, etc., infrastructure, all that's worth 2 million, and the rest of my project's worth another 5 for vertical build. I know divided by what that NOI is going to get me at a certain point in the future. I consider it stabilized NOI as opposed to the going in NOI, because we're not creating any value going in, we're creating value after we've stabilized the property. So divide that so that 2 million spread now would be, so 2% divided by that 7% on the yield to cost. So we'll divide the development spread, Douglas.
Okay, I'm sorry. And you want to divide what by what?
Yeah, so we're going to divide now the development spread. So that's 0.02.
0.02.
Divided by the yield on cost, which is 0.07.
0.07. Okay.
And that's going to give us what we call development lift or lift. And basically what that means is another way of saying we've created this much value in this project.
So is that like equivalent to the profit, you would say, or like
right.
Oh, okay.
Right. So this is how much profit we are going to create when we stabilize this property, get the rents to $400,000 in net income. Now, the reason this is important is because if we were just to say, hey, look, we've got, you know, $400,000 of NOI divided by a cap rate of 5, let's just say we got our valuation of $8 million bucks, right?
Mm-hmm.
But what if we put in $3 million? Like, what if we put in $3 million in order to get that $400,000 of net income, right? So that's why I think it's much more important for people to look at this, especially now as the interest rates are coming up, the NOI is coming down, right? Now maybe you're getting your rents, but the NOI is likely coming down and cap rates might be coming up. So you're going to see maybe some fewer development projects, and I think you're going to see some fewer heavy value add opportunities. So I didn't want to spend that much time on it, but I do think it's important. It's probably helpful for some people that are newer to the business to just think of it that way. Thanks, Douglas. So maybe you can get that out to people if people want to. I actually think I did something for your other group, Vinky, where I can find the deck and get it out to them.
Yeah, sure. Yeah, I will appreciate that. You can send that deck out to my, the group later on. That'd be good. So thanks, Doug. I'm going to close the whiteboard so we can
Sure thing.
highlight.
Thanks, Doug.
You bet.
Or maybe you can close it since you open it, right?
Oh, do I need to do it?
I don't know. Doug will do it because he's the one who opened it. So I'm going to shift the gears here a little bit, Andy. I'm going to ask you this question regarding, since we're talking about the numbers now. So what is the overall outlook for the lending environment? Because this asset class involves both the land development element as well as the construction of the homes, right? So how does that look like?
Yeah, you know what's interesting is you guys are benefiting from, I don't know, I think it costs a couple $1,000 to be at that BTR conference, and what I actually learned was that no one really knows anything. Right. I mean, that was the ultimate takeaway, as dogmatic as people want to say that they know what's going on right now. I will say a couple of things. There's still a lot of lending going on. We had many deals kind of in the middle of, at least two that were in the middle, where we had to adjust the SOFR up almost 200 basis points, right? It was at like 66, and now we had to move SOFR up. I think it was at 2.5. So obviously the spreads, you got to have deals now that make sense if you're going to be doing a development. The rent's got to support you paying 8% potentially for the build period. I think what I've learned is, I think this is interesting. You guys might not, but so for example, on a project that we're doing in Foley, Alabama, our lender will give us maybe 80% loan to cost, but I think we're probably closer now to 75 loan to cost. So that means on a $40 million deal for a development deal, I think it's actually, that one's a little bit less. Let's just say a $32 million deal, 25% is what, about 7 or 8 million that you're going to have to raise with retail investors. Now that's pretty expensive. So what there are now is some kind of second tranche or mezzanine guys that are willing to come in between that 75% loan to cost and that 85 or 90% loan to cost. And they don't want any upside, but they want to have, basically they want 12 to 14%, and they want collateral that's 2 times the amount of the equity that they're investing with you. So let's say that those guys are investing, let's just say 3.2 million. Let's say they get us up to 85% loan to cost. They want to have, they want our net worth and liquidity to be able to support not just this asset, because if this is a stinker, they want to have it attached to other assets that would be 2 times the amount of the equity raised. So that's 6.4 that we got to pull together from our other properties to support that. Now, before, that's fine, it's no problem. I got a team with, we've got a team with the net worth and liquidity. Now they're saying, hey, I think we want 100% owned. So that what that means is you can have your partnerships, but you've got to own with that particular partnerships 100% of the properties, right? You can have debt, but 100% of the property, which changes everything, right? Everybody on this call, if they've been in real estate, most people don't own more than a couple of different assets wholly. It's usually with partners or syndications, etc. So that's one kind of more strict. And then I think the collateral part is you can still get loans that are in that 5 range, and there's some community banks that are out there, but you got to be willing to deal with recourse loans, right? So we just closed on land that was I think it was like 28 acres, I think. We paid like 1.8 for it, 1.8 for that land. And then we'll basically have to we got it fully entitled. Our process usually is to entitle the land first with an option. So we'll give the owner $5,000-10,000 an option and entitle the land, and then we'll close on it. But in that particular deal for the lending side, Vink, we had to pay 12%, no prepay, so we can move as fast as we want. They gave us, I don't know, maybe 1.2. We had to come up with 6, something like that, just with the partners. But I got to sign the loan. I got to sign the loan. My other partner, Andrew G's got to sign the loan, and it's recourse. So you can you can still get stuff, but it's going to be a little bit, they're looking a lot more on track record and experience. But the good thing that I did learn is that there is a lot of kind of specialty lenders that are out there, that are willing to kind of be creative, and that the community banks, if you can kind of get in with your community banks, I think you really can have a huge opportunity to do deals like this.
Great. So you mentioned you're raising capital, so I assume you're syndicating these deals. So from the raise perspective, are you raising in like different phases? How many strands do you do for each deal? If you can tell us that.
So
and what does the waterfall structure look like, if somebody wants to invest with you?
Yeah, so this is an interesting kind of difference between development and multifamily. So in a syndication, and we could do this in a development as well. In a syndication, I would say, hey, look, $32 million deal. The infrastructure is, the lender's going to give us, let's say 25 million. We're going to have to raise 7 million, something like that. And then we would say, hey, look, it's going to take us, this long to renovate it, this long to get it stabilized, and the property would maybe cash flow a few percent for the first 6 months or 12 months or whatever, and then it would continue to roll, right? Now on the development side, there's multiple kind of value creation points. So for instance, when we buy the raw land, we pay a price with let's just say it's $1 million that we pay for our Lafayette, Louisiana. Now we need to entitle it. We need to go to the city. We need to go to the county. We need to go get hearings and get the project approved. So that's when we get it entitled. And then we need to pay for the engineering and environmental. All that's done. Let's say that's 6 months. So now we could either sell that land that is fully entitled with engineering in place and basically collect, whatever that value creation. Let's just say it's 1.5. We sell it, we made 50% on the money. I think it's probably closer to 75, but somewhere in that range, right, is the valuation. Okay, so now you're ready to go to what we call the horizontal phase, or the infrastructure phase, where you're putting in the streets and roads and utilities and all that. And at that point, that's maybe another 6 months, right? You got all the foundations coming in. And so you've got basically this completely done, the community's done, but you haven't started to build the units. So at that point, here's the thing where development and lending is so key, is because many lenders from that horizontal phase to the vertical phase will say, hey, look, what is the skin in the game that you had at the beginning of the project? So let's just say that you have $500,000, with your GP team or whatever, and you finished this $7 million, horizontal costing. That's how much it costs to get the horizontal in, infrastructure, streets, roads, utility. Some lenders will just say, hey, look, you got to go raise the rest of that money with, retail investors like us, or private equity, or family office. There's specialty lenders that are still out there now that will allow you to basically what they call land lift, or rolled equity, or imputed equity, that would basically allow whatever that new value that you've created from the horizontal transition, from the infrastructure phase to the vertical phase where you're actually building the units, you might get all of that equity creation. So let's just say now the project is fully entitled, all the infrastructure is in, and now you've got a new valuation, because there's going to be a lot of builders that would love to just, what they call shovel ready, go there, dig in their shovels and just build vertical. So you might be able to get 2-3 million additional dollars that you've created for your GP team and all those early investors that would roll into the next phase that you have, which would mean you would have to raise less, right? You have to raise less money. You'd have more money for that early. It's kind of like a seed round. You'd have more money for the. So this is why lending is so important. You could sell it. We could sell it and move on to the next project, maybe sell it to a builder and let him do all the vertical. But if you could leave some of that money in and roll it, then now you've basically created value 2 or 3 times along the way. And each time you've de-risked the project. I don't know if that I probably went longer on it, but
no, I think this is
we
good
had
answer. But let me ask you this question. When do the investors expect to see the returns?
so development deals, it's a little, it's different. I think you got to, so for Lafayette, as an example, what's 100 units, we're going to, because rents have increased, we'll probably be able to build about 6 a month. Okay, so we've already got 8. So, you know, let's just say that we're done in 10 months, 12 months. At that point, you probably want to leave a little bit of extra for conservative stabilization period. So it could be basically 12 to 18 months before you see a single penny on development. Some it's longer, some it's 24 months. I think what people have to consider on development deals, and the one that we've got in Foley, Alabama, is a opportunity zone. There's a huge difference, and I heard somebody say, hey, look, I'm looking at cash flow. I think there's a huge difference in deciding what you want, whether you want the kind of equity, you know, generational wealth creation, or you want to have that cash flow coming in. And let's bring in Brett. I think that for the Lafayette deal, we're going to stabilize quickly and probably sell it 3 to 5 years. So that's like a 2.6 multiple, and let's just say 3 to 4 or 5 years, right? That's pretty good. If you stayed in it for 10 years, you know, your IRR just keeps decreasing and decreasing and decreasing. And so at some point, you know, it probably makes sense to get out a little bit quicker. But an opportunity zone, like the one in Foley, Alabama, why would you want to kill the golden goose if you're getting, you know, let's say in year 2, 3, 4, you're starting to see returns that are like 14%, you know, annual return, and you take it and you just ride that for 10 years and then pay no taxes on any of those gains. Why would you want to kill that goose at like year 5, right? At year 5, and then try to go find a deal where you can get 14%. So I think you kind of have to, I think people have to consider kind of what their appetite is. On the development side, it's much more of a longer play. I think that there's ways for us to eliminate risk. You know, we're not presenting a deal before it's entitled. We will allow people to wait if they want to see if the infrastructure gets in. But ultimately, it's not a cash flowing deal right away. In fact, I just invested passively in a deal where the operators were telling us, hey, look, it's, you know, we're going to start paying out in 3 months or something like that. And I knew that wasn't true. I knew that wasn't likely, because I don't think most people know if a project is in good shape until probably the 9th or 10th month. You start paying out distributions too early. Yeah, the investors love it, but is the property sound, and is the team sound, and is the strategy sound? So I just got a call from an operator yesterday on a passive deal that Gina and I invested in, and they're like, you know, we're gonna sell it. There was a fire, and like we didn't get the insurance that we thought we were gonna get. We're just gonna sell it, and we'll get your money back. Maybe there's a small return, but you know, people are kind of, I wouldn't say they panicked anyway. I don't think they panicked, but I think that, you know, that was in a major market. I think that people kind of have to consider, like, all these bridge loans that were out there at, you know, 3, 4, 5%. Now you got SOFR up, you know, 3 times. It's going to be a lot of pain. So the lending part, as you mentioned, is a big part of it. And I don't know that, you know, I'd be curious to hear about your deals. Are you trying to cash flow right off the bat Minky, I mean, they're all different, I guess.
Yeah, I think all multifamily is a little bit different. You know that you're in a multifamily space too. So some deals are cash flowing deals day one. Some are you gotta wait. Like it's a heavy lift. Again, investors might have to wait 8 to 12 months till they see the first return. It happens. It's like, and we advise our investors from day one. Okay, you might not see anything, for the first 2 quarters or 3 quarters, and which is normal. But let me ask you this. You said your exit strategy is like 3 to 5 years. 5 years you're looking to exit, which is like the kind of similar strategy that we use for the multifamily. So, but the other thing was coming to my mind was this horizontal multifamily. That trend was on the rise, maybe due to this remote working, or people are moving into suburban, like more suburbanization, and also people wanted to have more room due to the pandemic. So now, do you think this trend will continue post pandemic? What do you think?
Without a doubt, like, if we're 80 years old and we're hanging out on our porch, Minky, and you're like, man, were you right about this built to rent thing? I should have listened to you. I have full confidence. Let me just put it this way. So Wall Street probably controls about 50% of the multifamily. And again, this is not like a multifamily versus horizontal multifamily thing at all. I think there's great deals all around. But I just want people to think about it in this context, that 50% of those properties that are owned by institutions, whatever, Wall Street or insurance companies, let's just say, pension funds. Only about 2% of the built to rent at this point is owned by Wall Street. So when you think about the increase in dollars, so what I'm saying is we're probably in like the end of the second inning, maybe going into the middle of the second inning, and so you have so much demand. One, you have this very little supply. And again, I think before 2008, I always we always thought of real estate as localized. There would be an ascension in one market and descension in another market. Southeast is doing great, West Coast not so great, etc. Now in 2008, we kind of changed our view. I think it's going back a lot to that. So if you can find markets where you got the population growth, where you got the income growth, where you got, favorable municipalities, where you got, maybe crime reduction, absolutely, without a doubt, secondary and tertiary markets are going to, and then the other part is $850 a month is a huge delta now from what people wanted to pay for their mortgage and what they can pay for rent. So it just, everybody knows kind of the Occam's razor, what's typically the most likely is the most right. So I just feel like in this market, if you've got rising interest rates, you've got rising rents, you've got very little in supply, and you've got this huge affordability gap. Just in general, those kinds of things, if you were just think about, yeah, in 10 years, of course I should have seen that. Now there's tons of things that can happen, and obviously there's bad operators, and we could over leverage ourselves, and there's probably plenty of built to rent projects. But if you're just asking me, built to rent, is Wall Street going to be controlling a much larger number and are many more renters, those that can afford it even? And like I don't know if that's the same. I don't know if it's the same like American dream for guys in their 30s or even 40s, right? Elon could basically buy businesses on his phone. He could invest in multiple real estate projects if he wants. And does he want to come home all the time and just tend to an older house, or does he want like his in his car, his air conditioning is all set up, and he's got his pool, and he's got people up above him or below him, and he's got his doggy door? Like, even if he could afford a place, there's a lot of people that would just prefer to be in this space. So that's kind of my view on it. I'm kind of curious what other people think. I know I start rambling on sometimes, but
that's good. I think this is good information, Andy. So basically you're saying now is a good time to deploy capital into this asset class. Do you agree with that statement?
I would say yes. I mean, obviously, there's caveats in this lending market, and certainly the numbers got to work. I think if you consider yourself, conservative underwriter before, I think you have to be really conservative now with the leverage that you bring in. You're going to have to give away more of your deal, right? because retail investors aren't cheap, right? They're going to want their 15% or 18 or 20 or whatever that percentage is. And so, yeah, but I think of any of the asset classes now, for those reasons that I mentioned, if there's anything that you can kind of think, what in that, like a market where interest rates are rising, what would be the class that would most benefit? And multifamily to a certain degree would too, right? Because people are going to need to rent more.
Right.
But if we're really thinking like, hey, I could buy a house at a higher mortgage rate, or I could live in something brand new with the same experience that I would have of owning a house with my yard and my dog and the community and the pool and the amenities of a apartment, you know, that would be something that seems to me would make sense in this market.
Thank you. I'm going to open up for everybody. Please, everybody, if you have any question, unmute yourself and ask Andy now.
Andy, I got one for you.
What's up, Douglas?
Hey, I'm not sure how much people understand residual land value, but could you talk a little bit about how residual land value helps you calculate your offer?
So be a little bit more specific, because I want to.
Yeah, I'm just driving at backing out the. So basically, you do your pro forma, you do your cost, your hard soft cost, and then whatever that plus a profit margin, and then that allows you to back out your maximum land offer that you can do.
Yeah. So it's interesting you're asking this question, because this is something that we just gone back with our team so many times. It's like, how do you value these projects, right? There's comps for the land, and some of them are much higher than they should be. And there's comps in the transition. Like, can you basically back out whatever the horizontal transition to the vertical is, and what's the actual value at that point? And I feel like at each of those let's just say transitions, there's value creation, but in this lending environment, there's only so much that you're going to actually get credit for. So I don't know if we were to look at what's like residual value at this stage is going to be the same as it was. So I don't know. I'm curious kind of your thoughts on that, because
no, it's a fascinating question, and I never thought about it, because historically, and this is again a new area from actually doing it to me. So this is still kind of a new area, but historically I understood that from a tax reason, and I don't recall what the reason was, you generally would do either the horizontal, and then somebody else would do the vertical. So it's always been kind of a like, hey, you hand it off to someone else. So I've never really thought about, taking it all the way through from doing both pieces. And then I'm also wondering if maybe the way to get at it is separate entities do, like we all control the same entities, and it's like, hey, we can come in here at this entity, and then when we get to this checkpoint, we're going to exit technically to the second entity, and then people can get in or out if they want, or they can roll. And
well,
so
this is kind of one of these things that just doesn't make sense. Like a bank will say, hey, look, I'm going to give you credit for a valuation that's basically where you were at your last stage. I know you could go ahead and sell it to somebody else at this value, but I'm going to give you credit at this value. Now, if you owned the land a year ago and you did all of this value creation, then I'm much more likely to give you the new valuation where the comps are. Right. But you're almost penalized if you move too fast throughout the project. So yeah, that's part of the kind of exit strategies that we like about build to rent, is let's say at that stage we figure out, hey, rates are just way too high. There's too much risk. A guy like Lennar could build vertical for rent or for sale much easier than we. Let's just take our money out of the project now, sell it at the new valuation with the horizontal and all that down, and then move on to the next thing. So that is an option. That's part of the reason in this opportunity zone that we're kind of conflicted. In the opportunity zone, you have to decide whether it's going to be an opportunity zone fund and you're going to go for 10 years. But from our perspective, can't we create much more value if we don't go early by doing the horizontal and the entitlements? And then at that point we decide, can we go can we go in the opportunity zone? And like you said, it's got to be a new entity. So then you're tricky about like creating a new entity that can kind of take it to the next stage. So that's part of the reason these specialty lenders that I can refer you to are helpful in giving us that imputed value that's so hard to sometimes, you know,
and then one other fascinating one, Andy, real quick. How lucky are you in terms of joint venturing with the current landowner before? Have you seen that opportunity quite a bit, or is it kind of hit and miss with that?
No, I'm seeing it. Actually, I was talking to my friend Amanda Williams, she has a lot more scattered built to rent. She might be good to have on the group. She really focuses on the land, but she's seeing a lot more owners now that are saying, hey, look, I got this great valuation. I could stay in and see this project with a good team actually, you know, come to fruition. That's pretty exciting. So, you know, truthfully, Douglas, by the time that we're seeing this project, our acquisitions team has already kind of come up with, you know, here's this next spot that we've got. But Chris Vaughn, who's basically done acquisitions for all the big institutions, yeah. That's his kind of, that's his MO, is I want to go to the landowner, figure out a way to partner up with them. If they don't, then you know, then we can move out, or maybe we get them in a phase GP. But I'm seeing it a lot. I'm seeing it. I think we're going to see it more because land values are coming down a little bit, and those guys are thinking, "Gosh, I could have got $1 million for the land. Now I can only get 8. Why don't I stay in and watch this project come to fruition, and make some of that delta that I lost in the, you know, by me stalling and asking for too much for my land over time."
Well, and it does seem to me you get to reduce some of your entitlement risk. If the landowner's on board with you, you get a little bit more leeway with the entitlement risk, it seems.
No doubt.
Yeah. Thank you so much. Anybody else has any question for Andy?
I'd be curious, is anybody else doing developing any built to rent projects at this point, or is it more kind of curiosity? I know Emma and I have talked about it just with the group.
We're doing short-term build to rent right now in the club. So that's kind of my first experience with build to rent that's not actual multifamily.
Is that the one in Florida? Where is it?
Yeah, North Carolina, Myrtle Beach. So I think that the concept is similar, except it's fewer homes and they're luxury versus starter homes.
Yeah, and so I think luxury, I remember hearing that deal. I think luxury makes a lot of sense in the like coastal markets, and for the same reasons that we're talking about. Like, yeah, you want to buy a great looking house, but maybe it's built in the 80s and you're going to still have the upkeep, or maybe rent something brand new in Myrtle Beach and then next summer, you know, somewhere down in, or wherever. So, and the fact that you can work from anywhere you want, why not, you know, be in these communities where you've got, and there's also not that stigma, right? When we were coming up of, you know, renters in the neighborhood. This is people that are making a choice to kind of live in this community. So
I'm looking for one in an area called Cedar Hills, Utah, just a 6 to 7 home development.
Oh, that's right. I think we talked about that. So where are you in the process?
Just talking with builders right now. It just came up actually today. So.
Oh, did it? Okay, so this is a different one we're talking about. So you it's not entitled, it's just raw land that you guys would take all the way through.
That's right.
Awesome. Well, let's talk land. See if we can help in any way. I'd love to.
Okay, cool.
My niece moved there a couple of years ago in Cedar
Oh,
Hill.
really?
It's a great town.
Yeah.
Getting really fast.
Yeah, it seems really, really interesting. So yeah, Andy, I can send you some numbers so you can see what it looks like.
Cool.
Yeah,
and there was somebody on here that was doing underwriting. Was that Brett? Who was doing?
I think it was Brett. Yeah.
That was
Brett.
me.
Have you ever underwritten any development deals, or is it mostly multifamily stuff?
Mostly value add, playing with the numbers that we have and then seeing what our numbers and pro formas would do if we tweaked what they had currently, raising rents to market, value adds, lowering expenses, raising other income, things like that. Yeah, but I haven't done development underwriting, although I'm very open to learning. Yeah.
Yeah, maybe we'd love to talk to you because maybe we get another set of eyes on some of the stuff that we're doing. It's always nice to battle test some of your stuff. But
Yeah, I'd love to talk with you more offline about it if you're open to sharing and play with some numbers. I got spreadsheets up right now, actually. Yeah.
we're using the anybody else using the I think it's Spencer Burton's model. Got a pretty good
Adventures
development.
in commercial real estate.
Yeah, he's got a pretty good development one.
Yeah, we did that one for our development. Basically bought the full copy, and then it's so ugly, investors can't read it. So we actually stripped out numbers and created report tabs, summary tabs, so that we could put that in our offering deck, because it's a robust spreadsheet, but it's really difficult for investors to get anything out of it.
Yeah, exactly. I agree. Totally agree. This should be eternal.
Yeah. He's not
Any
a designer.
Andy, question on modular building. Have you seen any great vendors in terms of modular building to speed the construction piece?
Yeah, so we've got a project around the corner. We're going through the entitlement process right now in Broussard. It's about 30 acres. We can build about 220 units. And as you know, with those, Douglas, the costs are the same. It's just the speed with which you can build is so much faster if you've got. So again, this kind of comes down to the municipalities. It's so everyone has kind of their different requirements. But yeah, we should Derek Alexandrenko, my partner, and actually a couple groups are talking about maybe building out modular for for the Broussard project. And that would be like, so you'd have all the same 2-2s, all the same 3-2s, all the same 4-2s, and just the same layout for all of those and just different elevations, which is great. I mean, that's kind of what we did for one of our projects we just did 100 units, all the same 3-2s, same, so you can basically build 8 to 10 a month if you wanted to, and then just different elevation. I mean, meaning exteriors, just different looks, driveways looks are different with the exteriors.
Andy, can you share your information? People like to connect with you, how they can connect to you?
Of course. Thanks for putting this together. Appreciate it. Thank you.
Yeah, thanks for coming, Andy. I'm going to stop the recording so we can do the offline networking here a little bit.